Well, good morning, good afternoon, good evening, everyone. My name is Alidad Vakili. I'm an attorney with K&L Gates. And today we're going to be talking about how to do a venture capital financing. So a few little housekeeping issues to take care of. We'll start in a minute or so. I'm going to be handling the tech in the background, so certainly appreciate your patience, as we get underway here. So today's presentation is recorded, as you heard. Don't provide any confidential information during the presentation, as it is a public source, and this is recorded, and the recording will be put up on YouTube and other locations. So if you do have something you wanted to discuss, feel free to reach me privately afterwards, and I'd be happy to talk with you. There will be a video recording that will be sent out to the attendees. So if for some reason you didn't get a chance to listen to the whole recording or wanted to watch it again, that will be made available to you shortly after the presentation. Okay. So just a quick little disclaimer. What I'm going to be talking about are sort of high-level general concepts. These are presented primarily for educational purposes. We are not establishing any sort of attorney-client privilege. Don't take anything that is being discussed today as attorney-client communications or legal advice. Happy to have discussions with you privately offline if you have any specifics you'd like to discuss. So just reiterating that my information will be made available, so you can certainly reach out if you wanted to get in touch with me on a personal level. So let me tell you a little bit about the overview of today's discussion. We're going to be talking about how to do venture capital financing. And so there's a number of components that go into that. I'll talk to you a little bit about my background. We'll talk a little bit about sort of the venture capital model. What do venture capitalists look for? What should companies or startups be looking for in a venture capitalist? What are some preliminary considerations you should be thinking about? And then we come to the term sheet, which is really sort of the start of the process, if you will, where you have interest from a VC, and now you're looking at actually negotiating and signing a term sheet. Next, we'll talk about deal documentation. So once you've signed a term sheet, what happens? What can you expect the documents to be? What can you expect the documents to address? What's the next step or parallel step with that is the diligence. So at some point, investors will start doing diligence on the company. What does that look like? What are the important key issues? How to best prepare for that? Side letters, which come up oftentimes, we'll talk a little bit about that as well. What are some common pitfalls that, inevitably sometimes founders and startups will encounter as they start to prepare for a VC financing or are going through the process of the financing? And then last but certainly not leastly is the closing and post-closing issues. So once we've gone through all the other issues, you've got a term sheet, you've got your documents, diligence, everything else. How do you actually prepare for and get through closing? How do you get across the finish line, if you will? And we'll certainly talk a little bit about that. So before I talk a little bit about my background, we are reserving about half an hour for Q&A. So I'll take a look at questions as they come in, but certainly welcome to keep your question at the very end, and then we can run through some questions right at about 10 o'clock. We'll reserve about half an hour or so. If for some reason I don't get to all the questions, feel free to reach out to me afterwards, and I'll try my best to answer your questions. So a little bit about my background. As I mentioned, I'm an attorney with K&L Gates. K&L Gates is a large international, fully integrated law firm. We're full service. We're in over 40 offices on 5 continents. We have about 1,900 attorneys, and we do basically full service. I'm in the corporate group, so what I focus in is on corporate, and specifically within that corporate group, a lot of focus on working with startups, emerging growth companies, helping them from A to Z of forming their company, helping them get structured, set up for financing, helping them with their financing, and then all throughout the process up until exit, which could be a merger and acquisition. Our firm does a lot of public securities work, so we do IPOs if the company grows to the point where an IPO might be a good exit. I work primarily in our San Francisco office, sometimes in our Palo Alto office. I've been working with startups for most of my career. I've really enjoyed working with startups, founders, entrepreneurs. I always find it fascinating, how dedicated the founders are, the innovation, the creativity, and it's just great to be a part of that and help, maybe in a small way to help guide them to ultimately becoming successful and having a successful exit. Okay, so let's talk a little bit about, whoops, sorry, going the wrong way. Let's talk a little bit about you. So let me start a poll. There's a couple of questions. If you could take a few seconds and answer those, it'll give me a little better sense of what the demographics are. I always found it to be an interesting bit of information to get, so I know exactly who I'm talking to and can hopefully tailor it a bit to that group. So you should see a couple of questions if you could take a few seconds, and I think there should be 3 questions. So I'll give you guys a little time to answer those. Always helpful to understand where you're located, whether it's here in the US, whether primarily in the Bay Area or other parts of the US, whether you're in Europe or Asia. In prior presentations I've done, we've had people sign in from Kuala Lumpur, from various parts of Asia, from South America, Europe. So it's interesting to see where the makeup is. And then also, whether you've ever been through a venture capital financing and you've had that experience already, and whether you're an entrepreneur or founder of a startup. So, okay, let's give it another couple more seconds. Okay. So just real quickly, I'm looking at the questions. It looks like we have about 16% in the Bay Area, 35% elsewhere in the US. So that's a good makeup. It's about 20% from Europe, about 14% from Asia, and then a few other locations around the globe. So that's great. It's a very diverse group. That's wonderful. As far as first-time entrepreneurs, about 35% answered that. Serial entrepreneur, that's great, 16%. Folks that are in an early stage company, 31%. Growth stage, 8%. And then venture investors, looks like we've got a couple folks there, 4% that are actual venture investors. And then we have about 80% of the group said they have not been through a venture capital financing, and about 20% have. So that's great. Well, welcome everyone. I'm really happy, and I'm delighted to be able to present to you. If you've already been through a venture financing, some of what I tell you may be familiar ground for you. Certainly welcome your input afterwards if you've got other thoughts based on your experience. For those that have not been through a venture financing, hopefully we'll make this a fun and informative presentation. There are a lot of things that go into a venture financing. Some of it is fairly common sense, some of it may not be common sense, but it's important to understand the process from beginning to end, and to really, as I always say, do your homework and be prepared. The best thing you can do for your company and for yourself before you embark on the adventure of doing a venture capital financing is to really understand what it is, to have spent the time to become as knowledgeable as you can before you actually start the process. It'll help you immensely to approach it that way. Okay, so let's go and talk about our first topic is venture capital, the venture capital model. So it's helpful to look at what VCs are interested in. What are they looking at when they're looking to invest in a company? And, the short answer, the home run, right? Everyone, it's probably heard that before, but, venture capitalists, they go out, they raise money, they create a fund, and then that fund goes and invests in startups, hopefully to generate a huge return. So they are looking for a home run. They're looking for a company that will be able to grow and scale, and at some point, within 4 or 8 years, roughly or so, to have an exit that's going to generate a multiple return for the fund's investment. And I say home run because generally 1 out of 10 or 1 out of 15 startups that get invested in generally don't, those are the ones that generate a huge return and makes up for all the others that don't generate a large return or just aren't successful and end up, cratering. So they're really looking for a company to invest in that they see can make it big. They're also looking for management. So what's really important to the VCs when they're looking at a company is the management, the team. Is it the right team? Do they have the right sort of experience and leadership, experience or knowledge about the company and being able to grow and scale with the company? Are they coachable? That's a really key issue too, because VCs typically come to the table with a lot of experience, a lot of knowledge. You know, if it's a reputable VC that's been around and has done a bunch of funds, they've been through this process many times, and they've got a lot of incredible insight into what can go right or what can go wrong. And the ideal relationship is one where they can help steer and guide you to becoming, you know, having that successful exit. So in order for that to happen, the management, the team has to be coachable, has to be willing to listen, be willing to accept criticism if it's appropriate. And believe it or not, you know, sometimes entrepreneurs are very coachable and very open to listening to more experienced or seasoned folks like VCs. And in some case, I've seen, you know, from personal experience where the entrepreneur is very sort of stuck in their ways, and he or she does not want to listen to and take advice. And if that displays itself in an interview or in a pitch or anything like that, that's never a good sign for the VC. So coachability is an important factor. Personal connection is also really important. And I'm sure many of you have heard this, but the best way to get to an interview or presentation before a VC is through a referral from somebody that knows the VC. They're more likely to give their, you know, more attention, be more open if they know that a good friend of theirs or someone else at another fund that they respect had referred you. Likability factor, we talked a little bit about that. I mean, the coachability, I think, goes into that. But also, is the team the kind of team that the investor, the VC, wants to work with? So they're going to be putting in a lot of time in addition to their money. They're going to be, you know, if they get a board seat, they'll be attending board meetings. If they have an observer right, which we'll talk about, they could also be attending board meetings. But they will be involved, or hopefully will be involved in a very positive way to help guide you. So they're going to want to make sure that the team also is likable, fun, interesting to work with, rather than, you know, a situation where it's just never pleasant to be working with the team. Exactly the same way as it would be in the reverse, right? If you're looking to find a VC and you've got a couple different offers on the table, you want to also be thinking about likability factor. Is this the kind of VC that you think you could work with, that you enjoy working with? Is it going to be a good working relationship? So we talked about management, we talked about the team. The market is another really important issue they're looking at. You could have a great team, you could have a great little device or product or technology, but if the market is not big enough, then it's going to be hard to sort of generate, you know, and scale the business to the point where it's generating enough revenue so that it can then have an exit with a multiple that's going to generate enough return so that the VC fund will be able to realize a profit. So the scalability of the business is critical. The size of the market is really important too. Can the business become a big business? That's another thing that when they look at market, they're also looking at whether or not your business could become a big business. You know, what's considered a big market, or what's considered, you know, it could be, you know, multiples in the billions sales per year. That would be considered a big business. So if that's what they're thinking about, then you have to be able to either scale or grow, you know, hopefully towards that goal of becoming a big business. We talked a little bit about technology, or product. You need to have some sort of technology or product that's got a competitive edge. It's protectable, you know, meaning you can get IP protection around it. And do you have early, or does the company have early traction? So you're able to get out into the market early on with your technology or product. Do you have users or customers? Do you have a prototype? Have you started or conducted any pilot programs? Do you have any current strategic partners that could be helpful, or that the VCs will look at and say, oh, okay, I know that strategic partner, they're very good, they're very experienced. I think this is good because they probably already are helping the company. Other Nice to haves are if you came through a well-known or well-respected accelerator or incubator. For example, Y Combinator is a very well-known one. They have a very strong vetting process. So before you ever get accepted to Y Combinator's program, you've already gone through interviews. They've looked at your financials. They've looked at your books. I mean, they've done a pretty thorough review. So if you come through their doors, a VC looking at that will give you a little bit more credit because they know that you've already been screened once. You've already been vetted. So there are a number of other accelerators and incubators. UC Berkeley has a number. And if you're able to get through those programs, that's also a nice boost in credibility for the VCs. And then scalable business, we talked about that. So those are some of the key things that VCs are looking for. So what are the investors' objectives? When you look at a traditional venture capital fund, they generally have a lifespan of about 10 years. And once they're created, they're looking to invest, as I mentioned, in a number of companies or a portfolio of companies with the hopes that, those companies they've invested in will ultimately become successful. And once there's an exit, will generate enough revenue to return a nice profit for the fund. Just a couple quick questions. So yes, we are recording this. The recording will be made available afterwards. And you should, let's see. Okay, yeah. So probably within the next day or so, we'll send out the link to the recording. So if you weren't able to watch the whole thing, you'll get a copy of that. So as I was mentioning, the traditional VC funds, they're looking for creating a portfolio of companies that will ultimately generate the revenues. There are other investors as well. They all have different objectives. It's important to understand the objectives because you want to make sure you're matching up your objectives with the right investor. So angel investors, they may have particular interest in an industry or particular technology. Some may be motivated more towards investing in, devices or technology or companies that are doing something positive for the community. Maybe it's renewable energy type businesses or something else, some social impact type of business. Strategic investors, that could be, for example, a vendor that you have a good relationship with. They may want to invest because there's synergies there that you can work on together. There's another type of VC that I call the corporate VC, and we've seen a lot of this activity recently where large companies, for example, Apple, Google, IBM, you name it, the large companies oftentimes will set up their own VC fund. And even though it is like a VC, it is a fund, they go out and will look for companies to invest in, oftentimes early stage, companies that are looking or developing technology that is complementary to theirs or of interest to what they're doing. And oftentimes it's a smart play because they'll help seed that company, get it going, help invest in it. And once it gets to a point where the technology is developed, that might be a great acquisition for the larger company. So what they do is they help another company develop technology that ultimately they may be interested in buying. So just like there are objectives for the investors looking to invest in the company, obviously the company has objectives too. And I'll touch on this very quickly. So obviously everyone's most likely heard that VC money is oftentimes called smart money because the investors will add a lot more than just their cash investment. They'll oftentimes add experience, knowledge, contacts within the industry. They oftentimes are there with management, meeting with management, talking to management, helping guide them to help grow, scale the business. And I've seen that, numerous times over the years where company gets into a bit of a pickle. They're not quite sure what to do. One of the VC investors has a board seat and they've been through that exact same drill. They've had companies that have gone through similar challenges and they're able to help guide them. Other times the VCs are helpful in providing contacts, whether it's customers, vendors, strategic partners, other investors. So it's definitely smart money and can be a lot of value brought in addition to just a cash investment. So we talked a little bit about, what's the ideal investment for the VC. Let's talk a little bit about preliminary considerations. And I'm looking, I'm going to try to save most of the questions at the end, but I will occasionally just look over to see if we've got any questions I can answer quickly. How to know how old the fund is? That's a good question. I'll touch on that a little bit. You do want to know when you're doing your diligence on investors, learn as much as you can about the various VC funds you want to go out and target as a potential investor. And there may be information you can find online. More often than not, you can ask those questions if you do get an opportunity to talk to the VCs or someone that knows the VCs well. If you're getting a warm introduction, then I would certainly ask the question, what age is their fund, or are they setting up a new fund? Is the fund that would be investing potentially, when was it set up? All of those are important, because if it's a fund that's close to the end of its lifespan, then there might not be much money left in that fund to do a follow-on investment, which is important to consider, because if they invest early on in your company and you're doing great, you've got the technology that's being developed, but obviously you're going to need more financing, then oftentimes when you go to raise another round, you go back to your original investors, and it's always nice to have them vested and staying vested with the company and participate in those additional fundraising transactions. So to the extent it's a younger fund, which has more money to deploy, they put in an initial amount of investment, then the chances they may also be available to put in more investment and participate in future rounds. So those sorts of considerations are important. Okay, let's talk a little bit about preliminary considerations. So one of the first things, and I won't talk much about this because I know there was another presentation that I did, and also my colleague Jason Gordon has done a number of these where we talk about how to position your company for venture capital funding, and we talk more about structuring it. So are you setting up the right entity in the right jurisdiction? Typically, the Delaware Corporation is the most favored type of entity, and Delaware is the most favored type of jurisdiction in the U.S. But yeah, that's something that is touched on in another presentation. Modeling round, we'll talk a little bit about that. And then the style of the deal documentation. So once you're at the point where you've got a VC investor, you've signed a term sheet, and we'll talk about term sheets in a few minutes, then the next step is to start working on the documents, the agreements that will be the definitive agreements for the financing, for the venture capital investment. Those come in a number of different flavors. Probably the most common and really what a lot of people in the industry, venture capitalists, angel investors, other investors, as well as companies look to as sort of the market leader in a set of really solid form documents, model documents, come from the National Venture Capital Association. So you can see up on the slide, I've got the link to their website. There's a lot of great information that the NVCA offers. They also have put up their model forms, which were originally created for a Series Seed financing, venture-backed Series Seed financing, and they're great forms to use. A lot of deals use those forms as a starting point, and then are tailored and negotiated from there. So they're annotated, so they provide some explanations as to some of the terms. But I can tell you from experience, they're oftentimes sort of the first go-to place for pulling forms to use for your financing. There are other types of other model forms as well. The other one that's fairly well known, not nearly as well known as NVCA forms, is Series Seed. The website's there; you can check those out. Those are a little bit, watered down in a sense, so they don't have as many of the provisions as the NVCA forms. They're originally set up to be a little bit easier, a little bit shorter, to do like a seed financing, a Series Seed financing. And I'll talk a little bit about the nomenclature for rounds, Series Seed, Series A, B. It used to be a number of years ago, there was a little bit more of a distinction between a Series Seed, for example, and a Series A or a Series B. In my view, that distinction, it's not really clear. It's been blurred a little bit over the years. So you could have a very large Series Seed, you could have a small Series A, but the Series Seed documents were created primarily for a fairly early stage Series Seed investment where you didn't need all the bells and whistles that the NVCA forms have in them. So they're also good to check out too. Their website offers some good information. Beyond those two, obviously a lot of law firms have created their own forms, or they've taken one or two of these model forms and adapted it for their own particular form. So you may run across that as well. So let me take a quick look at questions. One quick question: Is it important to have a sponsor to get a VC investment? What type of role does the sponsor usually take? Well, are VCs keen to invest in startups that have a sponsor rather than no sponsor? So I'm not quite sure what you mean by a sponsor. What I think is that typically the best way to get in the door with a VC is by a referral from somebody that knows the VC well. It's usually either a friend or a colleague, or it's somebody that the VC has done business with before. It could also be another fund. Let's say it's another investor or another VC that doesn't particularly invest in the industry you're in, but they know and have worked with another VC fund that does focus on your industry, and they're willing to make a warm introduction. Those I find are probably the best ways to get an introduction to a VC. With regard to sponsors, if you're talking about like a finder or a broker or something like that, that's certainly possible, although I guess it depends on the relationship that they have with the VC. But you usually don't see that formal of a relationship, and I would caution you to be careful and talking to folks that say, oh yeah, I can get you in touch with VCs and get you investments, and all it's going to cost is pay me a monthly retainer and I'll go and do that for you. Those are scenarios where you want to be careful and possibly stay away from. Finders come in and broker dealers come in different phases of a company, but there are a lot of regulations, securities regulations, that govern what a finder can do and what a broker dealer can do. And so you just want to make sure that they're reputable, they're licensed to do what they need to do, and that they really do have the relationships they have. Otherwise, I would probably steer clear from that. Okay. Preliminary consideration. So let me talk to you a little bit about some definitions, and then we'll do an illustration where you'll be able to see what they are and how they work. So one of the things that's going to be critical is when you're doing your venture capital financing is understanding your cap table, doing a pro forma, understanding what the investors are going to be getting when they invest money, because ultimately what you're doing is you're going to go out and sell a piece of your company to the investors. And so you need to understand how all of that works out, so that once the dust settles and you've closed, what does that mean for ownership in the company? What will you be left with of the company? What will your employees be left with? What will the investors have of the company? So some definitions that are really important. Pre-money valuation, as it says, it's the value of the company before the next round of investment. So if you're going to raise a venture capital financing, you need to come up with the value of your company before you receive that financing. That's the pre-money valuation. Post-money valuation, as the name suggests, it's once you've received the investment, what is the company valuation? And basically you take the pre-money valuation, you add to it whatever the investment is, and that's your post-money valuation. So if your pre-money valuation is 10 million, and you go out and sign a term sheet and end up getting 5 million in new investment or an investment, your post-money valuation is going to be 15 million. Issued and outstanding basis. So when you're looking at the cap table and looking at who owns what, if you're looking at the shares of stock that are issued and outstanding, that's the current ownership of the company, not including any sort of convertible securities or options or anything like that. That's just actually what's currently the shares that are currently issued and are outstanding. That's the issued and outstanding basis. The next definition that's important to understand is fully diluted basis. And what that means is essentially you look at your cap table and you factor in all the common stock that's been issued and is outstanding, plus you add in all other securities that can be converted to common stock. So for example, preferred stock, warrants, options, including options that are in an equity incentive plan, so your option pool. You count all of that as if all of those convertible securities had been exercised and converted into shares of the company. Very different number, but it's important to understand that number as well. And then we talked, I mentioned a little bit earlier, priced rounds. What's the nomenclature? What are these priced rounds called? And, typically it follows a sequence. So generally speaking, your very first round and, where you're selling stock, is going to be called your, Series C preferred. Anytime you're selling preferred stock, which is generally what investors, especially VCs, are going to want to buy, it's going to usually have some sort of letter reference to the round. So the first round you do of VC financing, if it's a Series seed, if it's large enough to be a Series seed, or VCs are investing at the Series seed stage, typically earlier stage, then that might be called the Series seed financing. Then the next financing, if you did another preferred financing, you would typically call that Series A, and then Series B, Series C, and so on. Again, there's no right way or wrong way to do it. I've seen companies do a Series seed, and then they do a Series A, and then they do a Series A1, they do a Series B, a Series B2, a Series B3. It's all relative to what exactly that particular financing is accomplishing with regard to the type of stock being sold, but that's generally how it works. As far as the amounts that you would raise, as I said, those lines have been blurred. It generally used to be roughly, if you're raising, less than $1 million, that might be a Series seed round. Anything from $1 million or usually a little bit more than that, maybe 2 to 5, 2 to 10 might be a Series A, and then, so on and so forth. Again, there's all sorts of exceptions. I've seen Series A rounds for 500,000. I've seen Series seed rounds that have been done for, 20 million. So I wouldn't be so much stuck to the size of it. It doesn't really matter what you decide to call it. It just should have a sequence, so the next one follows from the first. Okay, let's look at an illustration. So here where some of these definitions are illustrated. So this would look kind of like a pro forma, just a very general pro forma, and really more for illustrative purposes than anything else. So here we have an example of a company that has a pre-money valuation of 40 million. So you can see that. It has the new investment. So there's going to be a $10 million, let's say it's a Series A round. So the Series A is going to be 10 million. So the post money, as I mentioned, was going to be 50 million, right? The 40 million pre-money valuation, you add the new money coming in, 10 million, that gives you a post money valuation of 50 million. And then if you look at the lower part where it shows you, this is fully diluted. So that's, as I mentioned, the common stock issued and outstanding, 20 million, the preferred stock issued and outstanding, options, assuming they're exercised, warrants, assuming they're exercised, notes, any convertible notes, convertible security that let's assume has been converted, and safes that have been converted, and then whatever is left in your option pool that has not yet been exercised, as well as if you're going to create a new option pool or increase your option pool, what that increase would include that number as well. So if you total all that up, and in this case, it comes to 32 million. So on a fully diluted basis, the company has 32 million shares. Then you look at dividing that, the dollar investment amount by the number of shares, then that'll come up with what your purchase price will be for that round, $1.25. That's pre-money. Then if you want to see what the numbers will look like once the investment goes in, so you can come up with what the total number of shares the investor is getting by taking the investment amount, dividing it by the purchase price per share. That's going to give you 8 million shares. So they're going to be buying 20% of the company. And what's important here to understand is what's the dilutive effect or impact on the founders from taking on an investment. I mean, company needs money, so you're going to go raise financing. That has to be done to grow. But it's important to understand what the impact's going to be on the ownership of the company. And so if you look right here, you can see typically the founders hold the majority of the common stock initially. So here they have 20 million shares. They currently own, before the investment, they own 62.5% of the company. after the 8 million shares are issued to the investor, and they've gotten their 20% of the company, you can see everyone gets diluted, right? So from 62.5%, the common stockholders, I'll just refer to them generically as the founders, their ownership drops down to 50%. So it's always important to keep your eye on the ball, because you want to be able to understand what's going to happen with regard to the investment once you close. And believe it or not, I've had scenarios where they didn't do the pro forma, they didn't do this kind of calculation beforehand, and then there was a surprise after the fact that, well, wait a minute, how come I'm no longer at X%? Wow, my ownership went down significantly. Well, it went down significantly because you ended up selling 20% of the company to the investors. So doing this kind of a model before you actually before you sign your term sheet, so you understand what is going to happen once you go through with the financing is really important. Okay. All right, so let's talk about the term sheet. So once you've gotten to the point where you have a VC interested and you're sitting down to negotiate a term sheet, here are some of the things that are important to be aware of. And it all starts with the term sheet. So typically term sheets for a financing are non-binding with a couple of exceptions I'll talk about. So it's really a time when the investor and the founders get together, they sit down and they kind of figure out what the financing is what are the material terms of the financing. They put it down on a sheet of paper or a term sheet, and then that is used to then start drafting the definitive documents. So even though it's non-binding for the most part, and the couple of exceptions are, there may be an exception if there is a confidentiality provision, or if the investor doesn't want to have you go and shop around. So, they're committed, they're willing to move forward, they give you what they think is their best deal, you negotiate something, and then you go across the street to another investor and try to negotiate a better deal. So, in some cases, there might be what's called a no shop or exclusivity, so that you can't go and shop around for a certain period of time. The exclusivity and the confidentiality are oftentimes binding provisions, because you really do want those to be binding. The confidentiality specifically for the company, because throughout the process, you are going to be disclosing information about the technology and the company and things that are not otherwise known. And so, if they're going to sign a term sheet, you oftentimes will want to have confidentiality as a binding provision. And then the exclusivity is obviously something that's negotiated between the parties. Otherwise, the rest of it is oftentimes non-binding. But I can tell you this, even though it's non-binding, this is really the precedent you'll set for the terms as you move forward. So you want to be very careful. You want to really spend the time to understand what the terms are, negotiate a good term sheet, because it's very difficult after the fact, once you've signed the term sheet, to then want to go back and change the provision, because you've already agreed to it. So even though it's non-binding, if you want to go and change something you've agreed to with the VC, it sets a really bad precedent. It also signals that either you're inexperienced, or you're not quite sure what you're doing, or that there's a credibility issue. You said this was going to be the term you would agree to, and now you want to change the term. So anyway, keep that in mind. So looking at the term sheet, here are some of the things, the typical terms you can expect to see. And I'm going to run through the list and we'll talk about a few of these. So dividends, liquidation preferences, voting rights, protected provisions, and there's a list of others, as you can see: pro rata rights, vesting for founders, whether there's going to be a legal opinion or not, whether the investors get a board seat or not. So this is really important to understand, because what's going to happen in the term sheet is, obviously there should be reference to the valuation, or pre-money valuation or post-money valuation. In some cases, if the model has been done and you already know exactly who's investing and you can calculate it out, you can actually come up with a price per share. More often than not, the price per share isn't determined until a little bit later. But regardless, what's important is understanding what the investors are going to be getting, what kind of rights they're getting. So Dividends, if the company is going to issue a dividend, if it's got enough cash after all expenses and everything else are paid, is it going to issue a dividend to the investors, to the shareholders? And what kind of dividend might that be for a preferred investor like a VC? Generally, I've seen anywhere from 6 to 8%. But I can tell you that oftentimes startups are not in a position to issue dividends because whatever cash there is, they're going to want to use that cash to grow the business. So there's really not as much incentive to issue dividends, but it's still an important piece because if the dividend is too high, if you were in a position down the road a few years where now you're generating good revenue, you are in a position to pay back some of your investors. If you go to issue a dividend, if you negotiate a really bad deal and 15% goes to the preferred as a dividend, then obviously that's not a good deal for your other investors who wouldn't be getting that. Liquidation preferences is really key, and that's what a lot of the VCs will focus in on is they're going to invest a certain amount of money. They want to make sure that they're going to get back something before anyone else gets paid, any other preferred shareholders get paid, or any other shareholders like common shareholders get paid. So it's a preference. It's a preference when there is a liquidation. And a liquidation doesn't mean only if the company doesn't succeed and has to shut down. Liquidation oftentimes, or deemed liquidation event or liquidation event, is oftentimes defined in the charter and the certificate of incorporation as a number of things, including, for example, a sale of the company, or if the company were to go public. So if that happens and there's a amount of money left over after all the liabilities are paid out, that bucket of money is what would be distributed out to the shareholders. So the liquidation preference, it gives the preferred shareholders a preference in what they get paid. Usually it's, 1 times their investment, or it's the greater of 1 times their investment, or whatever they would get if they converted to common and then became a common shareholder. There's a lot of different ways to do this, and it's not, the 1 time is pretty typical. 1 time their preference, their investment. That's not, again, there's nothing set in stone here. It's all subject to negotiation. But oftentimes what the investors are looking for and what's typically market, there'll be that sense of, whether it's 1 times or one plus times what they've put in, or it's whatever they would get if they converted. There's other ways to do that as well. But that's key, because that's going to tell you, if I do have an exit down the road, who's going to get paid first, who's going to get paid how much, and how much money will be left over for the common shareholders, which are typically the founders, once the preferred stockholders are paid. Voting rights is another really critical piece, and it's whether or not they're going to have a particular vote. Is it a 1-for-1? Is there some other kind of vote to be aware of? Protective provisions are important as well, because these are provisions put in place to protect the investor's investment. And so, for example, there's a list of actions the company can make, but in order to make those actions or to do those things, they need to get the approval of a certain percentage of the preferred shareholders. So as an example, if you're going to go and sell the company, there may be a protective provision that says you need to get a majority of the preferred shareholders to agree. It's designed to protect their investment. Important to focus on that, because if there's too many provisions, too many protective provisions, it limits the company. It doesn't give the company the flexibility to make certain decisions. And so oftentimes a little negotiation on that point. They're going to want to invest, they're going to want to protect their investment. You're, as the founder, are going to want to make sure that the company still has enough flexibility to be able to operate properly and reasonably without being unnecessarily fettered. So every time you want to do something, you got to go talk to the preferred shareholders to get their approval. Optional mandatory conversion, the preferred by its nature oftentimes it can be converted into common upon certain things happening. It's important to understand what those conversion situations are. Anti-dilution protection. So if you later on go to sell stock and you sell it at a lower price than the existing investors paid, do they have a right to get additional stock at that reduced price? Is there some other mechanism? Is there an ability for them to continue to buy and maintain their percentage interest in the company? All designed to help them protect their investment. The others, I'm not going to touch on all of these. Pro rata rights, I just mentioned that, the ability for them to participate in the future, to buy more shares, to keep their percentage ownership the same. drag along and ROFR rights are pretty common too. So ROFR, right of first refusal, and co-sale is, if certain key holders, oftentimes the founders and maybe some other key folks in the company, want to sell their stock, before they can sell it, they've got to first give the offer to the preferred shareholders or the investors to buy that stock. And in some cases, there's a secondary right to the company, so the company can buy it if the investors pass, or it may be reversed. So first the right goes to the company. If the company decides not to buy the stock, then it would go to the investors. Again, another way to sort of keep the shares close to the vest, within the group of investors or within the company, so you don't have a lot of other new investors that maybe the company wouldn't want to be a part of the company coming into the company as an owner. Okay, so I know we're starting to run out of time. I'm going to go a little bit quicker here. The main documentation we talked about. Here are the typical documents you can expect to see: stock purchase agreement, disclosure schedules, the certificate of incorporation, investor rights agreement, voting agreement, right of first refusal, and wholesale. They're all designed to do different things. The stock purchase agreement is the main agreement. That's where all the terms of the investor coming in and purchasing stock, what is the conditions for the closing to happen, what needs to be done, how much stock are they buying, how many shares are they getting, what are the reps and warranties that the company is giving. That's a really critical piece, because you want to make sure that's carefully vetted so they're all accurate, you don't have any issues. The disclosure schedules are prepared oftentimes by the company with counsel to disclose anything, to make sure that the reps and warranties in the stock purchase agreement are accurate. So as an example, if you say, we're registered in every state that we're required to register in or qualify in, and you're a Delaware Corp and you're doing business in California, so you've registered in California, but let's say you've got a bunch of people in Colorado or in Florida, and you're doing a lot of business in Florida, but you've never registered or done, qualified to do business in Florida. That's a disclosure issue. So that would show up on the disclosure schedule. So even though the rep says you're qualified everywhere you need to be in compliance with applicable laws, you then in the disclosure schedule say, understood that rep. However, we're letting you know, I'm disclosing to you, we're not qualified in Florida. So you're making sure you're disclosing that information. The certificate of incorporation is the charter for the company. So that's where a lot of the issues I talked about that were in the term sheet, the liquidation preference, the dividends, and things like that will show up as far as some of the protections the preferred investors, the VCs are going to want to see. And that's becomes then binding on the company, as well as all the stockholders, as far as how those proceeds get distributed in a liquidation event, the voting, protective provisions, things of that nature. The voting agreement goes hand in hand with the other docs, but also the charter, because that's where you can get more specific. So oftentimes VCs, if they're putting in enough money, if they negotiate a board seat, the voting agreement might specify exactly, how many board seats they get, who gets on the board, and then also has everyone commit to voting for, let's say it's preferred A, Series A. The Series A will vote to make sure there's a Series A director on the board. So it handles things like that. The ROFR, we talked about the right of first refusal and co-sale. There's other aspects to that too, but that's sort of just a general flavor of the type of documents you'll see in a VC financing. Other documents you can expect to see, and which are helpful, is not really part of the deal, so to speak, but the closing checklist is a really helpful guide as you're going through the process. You have a checklist that tells you exactly what documents there will be, exactly who needs to sign them, what the status is of each document. It's a really helpful guide. Oftentimes, the lawyers will prepare that and sort of manage that and share that with the company or the investor, and everyone can focus in on that. So it helps guide you through the whole process. You'll need to get board and stockholder consents to do the financing. So you'll need to have those in place. There may be certain waivers you'll need. You may have already agreed with other prior investors that in order to do certain things, you'll need to get their permission or their approval. In some cases, you can get them to waive that. Side letters, which I'll talk about if we have time. The pro forma cap table. I did talk about that a little bit in the illustration. So essentially, the pro forma cap table is it's a projection of what the cap table will look like when you factor in the investment that's coming in. So you calculate out, as I did in the illustration, what the existing ownership is. number of shares, et cetera, that are there. And then you factor in what the new ownership will look like once the new investment has come into the picture. And you want to do that because obviously that is going to help you determine, for example, what the ownership, the dilutive impact will be on the owners once the transaction closes. So it's important to understand, what investors are coming in, what amounts they're getting. That's going to impact the cap table and the dilution. So running that is going to be helpful because that's also going to help you sort of manage that round too. I mean, are you getting too many people in? Do you need more people in to fully subscribe the round? What is everyone's interest going to look like? Individual investors may say, oh, I want to put in 3 million or I want to put in 5 million. I want X percent or Y percent. That pro forma, you easily change the values and calculate out and kind of manage that. So you understand exactly what's going on in the financing. Legal opinion, in some cases, there's a legal opinion provided to the investor. I'm not going to spend much time on it, but it's something the lawyers will prepare. It's a pretty involved process, can be pretty expensive. In some cases, it's a requirement. We're not seeing as many of these, and we do see a fair amount. The value is always, subject to discussion and debate because they're heavily qualified. And then the last item is just cleanup, because oftentimes there's a lot of cleanup that needs to get done before the investment closes. So do you have the right agreements in place? Is everything up to date? Is anything need to be cleaned up? Documents that weren't properly signed need to be signed, or the documents that the investors want to have in place, put in place, things like that. Okay. Let's talk a little bit about side letters. So oftentimes you may have investors that are maybe not the lead investor, but they're coming in with a sizable check. And although they're not going to be treated the same way as maybe the lead investor or major investor might be, they still want to get some additional rights that aren't provided for them in the stock purchase agreement and the other deal documents, because they're not at the same level, let's say, as a lead investor. So oftentimes the company will sign a side letter and agree to provide that particular investor with certain things that it's outside of the main deal documents, but it's important enough for them that the company can negotiate and give them a side letter that gives them the things that they're looking for. It gets a little cumbersome if you have a whole bunch of those to manage those, because every time you do a deal, you got to go back to every one of your side letters, make sure that you understand what's in there, because just like in the main documents that I talked about, there might be certain agreements that are made where if you're going to go and do something, they have the right to participate, or they have the right to consent, or they have the right to be informed of. And so you just need to make sure you're managing that properly. The diligence process. This is a really critical process in a venture capital financing. So, when you're doing your venture capital financing, you've done your initial prep work, you've modeled out your pro forma, you've signed the term sheet, the lawyers are drafting the documents. Once you sign the term sheet, typically is when the diligence will start. And the diligence really is where the investor and their counsel and perhaps other advisors are now going to look at your company under a microscope. They're going to want to see all of the, whatever records are going to be important, with the main goal to assess risk, to identify and assess risk. So where might there be risk, potential liability to their investment within the company? And so the three main steps that I see anyway, as far as the diligence process is, first and foremost, organizing your company records. And this should be done well in advance of even talking to an investor. Get your company documents organized, in some fashion that it's easy to find them, easy to identify them, make sure they're complete. You've got, signed copies, dated copies, if they're agreements or what have you. Because if you don't, there's going to be a mad rush once you sign the term sheet to get everything ready to put up in a data room. And it's just a lot of stress and angst with you rushing around at the last minute trying to find stuff. If you prepare it now and get it up there, then you're done. It's just a matter of updating it from time to time. The next step is setting up a data room. Critical, because the documents have to be somewhere where the investors can get access to them. So having a data room set up, it serves two purposes. One, if you have the kind of data room where you can kind of track progress and see, then you can identify who's looking at what and getting access to what. But more importantly it's a place to put those documents. So when the investors start their diligence, they can get in, they can get access, and it's organized in a way that's easy for them to go through it. It'll help speed up the process tremendously. The third, which maybe is not in the right order, but is the diligence request list. So you can expect once diligence starts, the investor or their counsel is going to send you a very long list of all the things that they want to get. And a lot of them will be documents. Some of them may be questions or information that they're going to be asking for. And it's going to be basically everything under the sun and the kitchen sink. So they want corporate records, the capitalization tables, security documents, shares you've issued, business plans, list of IP. In some cases, they want to do a deeper dive and look at the IP. They may want copies of patent applications, material agreements, customer agreements, supplier agreements, partnership agreements, things like that, employment documents, any sort of litigation or disputes or threatened or pending disputes. If you have subsidiaries, the same sort of documents for your subsidiaries. And then it could be a host of other things. If you're in an industry that's heavily regulated, they may want to see issues related, documents related to the regulatory compliance that you're doing, things like that. So having all that organized beforehand is going to be super helpful for you. Okay, so whoops, sorry. Okay, the diligence and the documents go hand in hand. It's really critical to understand this piece. So once you've got the deal documents that are drafted and the investors are doing diligence, then the company needs to make sure with their counsel is to go through all the reps and warranties of the document, specifically the purchase agreement, and make sure those reps and warranties are accurate. And if there's something that needs to be disclosed, that's when you create the disclosure schedule and put it on the disclosure schedule, so that at the end of the day, when that agreement is signed by the company, you can be comfortable that that every single rep that's made in there is accurate. The company can stand behind those reps. There's nothing that's misleading or that you've misrepresented anything or omitted to indicate something that would be critical or a material term or material disclosure. And so that's how the diligence process works hand in hand with the deal documents to make sure that those reps and warranties are carefully reviewed, disclosure schedules are created. That helps the company assess risk and mitigate risk. It also helps the investor do their job and make sure that they're finishing their diligence and assessing risk properly as well. Okay, we've got a couple more minutes, so let me see what else. Key diligence issues. This is just a very, very short list. There's a lot of other issues that come up, but ownership of intellectual property oftentimes is at the top of the list. If the VC is investing in a company that has really good technology that's protectable, they want to make sure it's protected. So they're going to look for documents that relate to not only looking at the IP, but also looking at, do you have the right kind of documents in place to make sure that the company owns the IP, so there aren't any issues down the road. Capitalization issues, we talked a little bit about that, making sure that the cap table is accurate, that everyone that says that they have stock, that everyone on there that says they have a certain number of shares actually has it. There are documents to back all that up so you can show and evidence that, yes, this person bought these shares on this date, that if you granted stock options, you did it pursuant to a plan, it was done in compliance with whatever, taxing authorities, IRS and, state authorities, securities compliance issues are all handled appropriately, as well as any issuance of securities is done in compliance with the securities laws. That's just a handful. There's others: employment, tax, financial diligence that can oftentimes be a key issue as well. Okay, so I got a couple more minutes and then we'll turn to some questions. But on closing, which is really, ultimately you want to get to a point where you're at the finish line and getting over the finish line. So the closing logistics and the order of how you can anticipate proceeding to closing is, once all the term sheets signed, the deal docs are in place, they're finalized, they're ready to go, you need to get the board to approve the transaction. Then the stockholders need to approve the transaction. And depending on what your current charter says, your certificate of incorporation, will depend upon, what the percentage vote you need. But generally it's a majority vote. It could be higher, but you need to get the right number of shareholder votes to be able to approve it. You then need to file your amended and restated certificate of incorporation, because what you're doing when you're selling preferred stock in a financing, you're actually going to be creating a new class of stock. And let's take a Series A example. You're going to be creating Series A preferred stock. In order to do that, you have to actually file an amendment to your charter your certificate of incorporation to create it, and then to build in the rights that have been negotiated with the investors, dividends, liquidation, protected provisions. So all of that needs to go into the charter. So essentially you amend and restate your existing charter and then file that with the Secretary of State. Then the next phase is you got to look at all the closing conditions that you need to satisfy in order for the closing to happen. So in order for you to agree to close, in order for the investor to agree to close, certain things have to happen. Documents need to be signed, charter needs to be filed, requisite approvals need to be had, things like that. The next process logistically is the parties, once that all's all done, you exchange signature pages to be held in trust, typically by the lawyers representing the parties. And then there'll be either a closing call or via email. Everyone will say, yes, we're ready to close. The signature pages will be released. The investors will wire their funds. And then once the funds are actually received, that's technically when closing is typically considered to happen. And then documents get put together in a closing binder and sent out. There's a couple things that happen post-closing, some securities filings that are important to do, notices that may go out to stockholders that didn't sign, didn't approve the transaction, issuing stock certificates, and then putting together a closing binder. So I know I kind of rushed through some of that a little bit quickly. And then the last thing, and I know I'm running a minute or two over, here are some of the common pitfalls that I see when you're doing a financing. And if you're not ready or don't have the right folks helping you, not being ready to do one. So the company might not be ready to do a financing. VCs are only going to come in, as I said earlier, when you got the right team, you got technology, you can show scalability, all those factors. So if you're not quite there, it may be too early for you. You might not be ready. Not preparing before you start negotiating your term sheet. Make sure you understand the terms. Make sure you understand how investors negotiate their term sheets. Get advice. Get an attorney on board to help you negotiate your term sheet. And then, preparing your pro forma cap table, ideally before you sign your term sheet, but helping, go through that and then actually working on it and creating it. Understanding if you've got any finders, any security law issues that are, if you're not following the securities laws, that can be a big problem. If you have a finder that helps you, get financing, but they didn't follow their very narrow corridor of what they can and can't do, you can get into trouble. They can get into trouble, but it can be a problem if they're violating securities laws and doing things they shouldn't be doing. And then not having good, clean corporate records. I see that oftentimes being a major pitfall because it takes time, expense to clean all that stuff up, and it can potentially delay closing. So I know I went over, I apologize. There was just a lot of material to cover, but let me turn now to some of the questions that were asked, so I can hopefully answer as many as I can. Let's see. Yes, I know multiple people asked. The recording will be made available, so you'll be able to see it. I know Idea to IPO usually puts this on YouTube, so you'll be able to see the presentation as well as the slides that I was talking about. So if you missed it, any part of it, then don't worry, you'll be able to see it. How much time from showing interest to closure does it take? So from the time you have, I would say from the time you sign the term sheet, because everything prior to term sheet being signed is just interest. It's not really committed interest. Once an investor signs a term sheet, they're really interested and they're now committed to go forward. I would say I would count on no sooner than 30 days, and that's probably a fairly aggressive timeline, depending on how complicated the deal is and how much negotiation there may be and how much diligence there may be. You can anticipate anywhere from 30 to 60 days. I've seen some transactions carry out 90 days, but I would say probably 30 to 60 days is a reasonable time frame. Okay, another question that came in is, how much does it cost for a startup to pay for a lawyer? A great question. And, I can tell you that, a lot of firms like ours, we work a lot with startups. So, our peer firms that we're competitive with, we're all in the same, scenario. We're working with startups that don't have, usually are very budget conscious. They don't have a lot of cash at that point early on. And so we're very aware of that. And we try to work with them on either, some sort of an alternative fee arrangement. So it could be a reduced billing rate. It could be a deferral of fees. There's a number of ways that attorneys can work with you on your fees. The rates all vary across the board. Smaller firms typically charge less per hour than the larger firms do. The benefit of sometimes the larger firms, you get more experience, you get more access to other specialists that will be very helpful, especially with the VC financing. as well as, you know, the reputation of having a firm that's been through the process and well known by investors. Happy to entertain or give you more specifics offline if you want to reach out to me. Okay. Is fundraising using safes and term sheets a completely different process? So is the safe part of it? No, a safe is an actual type of an investment instrument. So I was focusing on venture capital financing, which is almost, I won't say exclusively, but predominantly done when the company sells preferred stock. That's typically the way VCs will invest. They want to purchase preferred stock for all the reasons I talked about, the way they can protect their investment. However, a lot of companies will raise financing, oftentimes early stage. They will raise financing by either doing convertible notes, which is basically a promissory note that can, you know, the amount can be converted into stock at a later date, or a SAFE, which is a, you know, simple agreement for future equity. It's a very simple agreement by its name. It's a investment agreement that allows the investor to convert the amount they've invested into shares once there's a qualified financing, you know, at a later date. So it's different than a term sheet. It's not a term sheet. You can actually have a term sheet prepared for a safe investment or a convertible note investment, but the two things are not the same. A term sheet is not, is really a starting point. Think of it this way. It's kind of an outline of what the parties are going to agree to once the definitive documents are prepared. To operate, another question that came in, to operate the company outside Delaware, do I need to file new articles of incorporation in the outside state, for example, Texas? So what you do is if you have a Delaware corporation, you will file your certificate of incorporation in Delaware. Then if you want to go and do business in another state, there's a special form, typically each state has its own form for qualifying a foreign corporation in that state. You fill out that form, and then you will oftentimes include a copy of either the certificate of incorporation you filed in Delaware or a good standing certificate. There'll be some information that will be needed. And then you file that form in the state, in this case, question Texas. And then Texas will recognize the Delaware corporation as being approved or qualified to do business in Texas. So you don't file a brand new certificate of incorporation. You file the appropriate form to qualify the existing Delaware corp to do business in the state that you're in. Are there good websites where we can see fundraising, closing documents, templates to better understand? Yes. So early on, as I mentioned, there is the NVCA, which is if you Google NVCA, you'll come up with their website, or Series C. Both of those offer good forms. As I mentioned, NVCA forms are probably the most well-known and most widely used set of forms, certainly in the US. That's a great resource. So I would certainly go there. And I forgot to put my number and my email in case you want to reach out to me afterwards. So I would check those websites. If you Google as well, there's a ton of information, a ton of materials that will help you as well understand some of the terms and terminology. What is a good percentage of the company to offer to investors and angels at the pre-seed stage? So that's a great question. I know I talked about this in an earlier presentation that I had done. Actually, a couple of presentations I've done. You know, it's not something I give you. There's no rule of thumb. It's a factor of, you know, what the investment is, and, you know, who the investor is, and what they're going to be doing besides just putting in cash. And so, you know, the only thing I would say is be very careful when, you know, if you're doing sort of, you know, as you called it, sort of pre-seed stage. So this might be family and friends, or maybe very early investors, angel investors, what have you. Just be really careful. And obviously, you know, you don't want to give them too much, but you obviously need to, you know, make sure you give them enough so that they're interested in investing. You know, friends and family, oftentimes they come in because they know you, they trust you, they want to work with you, they want to invest with you. They're there to really support you, not necessarily the business, you know, itself. And so that's a different kind of ballgame. You usually have more latitude and flexibility in negotiating with them than if you were to go to, let's say, an angel investor that you didn't know previously, didn't have a strong relationship with, you know. But typically, I mean, it's not a large amount unless, for example, they came in and it was an angel investor very early on that was going to commit to, let's say, you know, $10 million $5 million and it was a huge amount more than what you were asking for, what you initially needed, yeah, that changes the dynamics. You may be willing to offer them more than if you had someone come in and say, oh yeah, I'll put in 50,000. What I've seen happen, and the pitfall I would caution you on is, you get a bunch of very, very early investors. They want to put in money. They want to put in a small amount, but they want a large percent of the company. I would just be very careful. And anything beyond that on specifics, I would just, feel free to reach out to me offline, but just be cautious with that. Okay. Another question is, and how are we doing on time? We got time. If an investor has industry knowledge and they will likely already be invested in a competitor, would you still consider their investment? And will they sign a binding confidentiality clause, as you mentioned, when the term sheet is signed? Great question. So as I mentioned, a lot of these VC funds, they create funds and they're looking to invest in a portfolio of companies. Oftentimes VCs, they like to invest in what they know. So you'll see a lot of them will focus on a particular industry, in some cases, particular type of technology or particular type of business model. So naturally, they have probably invested or would be looking to invest in other companies that are similar to yours and may be a competitor of yours. That's not necessarily a problem. It happens all the time. Obviously you should do your homework and study the VC fund and see what they've invested in. Oftentimes their websites will indicate companies they've invested in. So you should be able to easily find out if they've invested in competitors. And at the term sheet stage, I did mention that oftentimes, you can have confidentiality be a binding provision. And so if that's of concern to you and you know that they've invested in competitors, I don't think there's anything wrong with asking for that confidentiality piece to be binding. I will tell you though, at the term sheet stage, it's more common than not. But one mistake I've seen a lot of founders make or startups make is they go to their first interview or before their first interview with the VC, they send them a confidentiality agreement and say, hey, I need you to sign this before I talk to you. Most VCs, probably 99% of them, will just absolutely refuse because they are getting hundreds and hundreds of business plans and are meeting with people all the time. And if they signed a confidentiality agreement every time they were going to meet with someone, they would be having to manage thousands and thousands of these agreements out there. And it just becomes impossible to manage at that point. So they're typically not going to sign a confidentiality engagement, prior to the term sheet, but at the term sheet stage, you certainly may be able to get that as a binding provision. Do micro VCs do follow-on rounds? To what extent do they go to? That's a good question. The only thing I can say is I think each VC has its own sort of methodology and practice for how they do their investing. Some VC funds are interested in putting in an investment, and they don't necessarily want to commit to doing a follow-on investment. Other VC firms, have in mind that, yeah, I'm gonna get involved at this stage in this investment with this company, but I've already anticipated and set money aside to invest in subsequent rounds because I believe in the technology or the company. They're not going to be able to get there with just this initial round. They're going to have to do subsequent rounds, and I want to be there when they do that. So it really depends on the VC. Recorded seminar will be available. I've heard a lot not to offer more than 10% of the company at the pre-seed stage. Otherwise, after price series, you will be way too diluted. Yeah, yes. I think the concept there is, yes, don't offer too much at the pre-seed stage because the more you offer early on, subsequently, the more you give to VCs and later rounds, the more of a dilutive impact it's going to have on certainly on the founders. So that goes back to making sure you model it out and make sure you're constantly keeping your eye on the bouncing ball, if you will, the ownership, so that you don't give away too much early on, so you're left with a lot left to give away later on. Or if you do give away a lot later on, you're going to be having to deal with a huge dilutive impact. So yes, definitely be aware of that. And I don't know that I can say, never give more than 10%, but I think, yeah, that I'd say that you want to be careful with giving a lot early on. Another question, if there are multiple investors, do they get the same term sheet? and clauses, or is that up to negotiation with each investor separately? That's also a great question. So usually the way it works is you'll have one investor that's going to be the lead investor, and it's oftentimes the investor that's writing the largest check. Not always, but it's oftentimes the one that's writing the largest check because they've got the most leverage. They're going to be putting in the most dollars. So frequently they will become the lead investor, and that's the investor you negotiate your term sheet with. So you negotiate the term sheet, and then typically you negotiate the definitive documents with that lead investor. And from there, it really depends on who else is getting involved. For example, if you have already taken on other investors, maybe it's other VCs or it's other significant investors that invested in a prior round, they may want to have a say-so. They're going to want to look at the documents, and they may want to negotiate some terms as well. You may also have other investors, new investors. They're not the lead, but they're writing a big enough check that they're going to have some influence in the negotiation process. And so you may also have to deal with negotiating terms with them. But to answer part of your question was, once you get to the point where you're working on your definitive documents, yes, you want to have one set of documents that's going to be signed. That's going to be what every investor that's going to be buying in that round is going to sign, and that's what they're going to agree to. Now, if there are some variations that are negotiated specifically with one investor or another investor, that's where the side letters can come in. But the side letters are not intended to start varying a whole bunch of provisions here and there. They're usually only focused on a few things, and that's some issues which can be dealt with outside of the main documents. So, for example, access to information, so information rights or preemptive rights, pro rata rights, things like that. Those can oftentimes be negotiated outside of the main deal docs. What you don't want to do is start negotiating a whole bunch of other provisions with, that are outside of the deal docs in the side letter, like reps and warranties, indemnification, things like that. All of those should be negotiated finally with the lead and anyone else who's got enough influence to be able to negotiate terms. And once you've finalized all that, that's your final set of documents that all of the investors would sign. Another question that came in, do you recommend startups use third-party solution providers such as Carta, or just office documents between startup and attorney? That's a great question. So Carta, if you're not familiar with Carta, is a program that's a company that's been around for a while. They originally called, I think, eShares, and they originally started off with a very simple program that helped you manage your cap table. So essentially, it was a really fancy spreadsheet and a way to put data in to be able to manage your cap table. It made it easier for the company startups to manage ownership of shares and options and things like that. They've grown significantly since then, and they offer a lot of great services. In addition to the cap table management, they can also do now 490 evaluations and things like that. So I've been seeing more and more investors, like VC investors, when they come into a deal, they actually will want the startup to start using a company like Carta because it just makes it a lot easier. It makes it a lot more efficient and cost effective to manage the cap table. So in some cases, I've had investors say, look, you have to use a program like Carta or Carta, otherwise I'm not investing. It doesn't happen as often, but it's certainly something good to think about. Their price point is not, you have to pay a subscription fee. There's various types of subscriptions. As a startup, if you got in on the very early, cheapest subscription, you could call them and find out. But basically, they're fairly reasonable. It gets you going, gets all your data organized. So part of the diligence process that I mentioned, which is so critical, is if you're using a program like Carta and all your data is up to date and you've been keeping everything up to date, it's super easy to generate cap tables, to generate other reports. So when it comes time to doing the diligence, you can basically very effectively give the kind of reports that the investor and its counsel are looking for without having to go through and make sure your Excel spreadsheet's up to date, or maybe you've got multiple Excel spreadsheets, or you've got other data here and there. It's all in one place with regard to the cap table. It's very easy to manage that piece of the diligence, easier to manage that piece of the diligence. Carta is one that we use a lot. So that's probably one of the most well-known companies that I'm aware of. I know there's some other ones that I don't recall the names offhand, but Carta is really is one that comes to mind. So I would certainly look into Carta. Okay, so those are, I think those are all the questions that I saw. Oh, looks like we got another question. What type of package do you offer for pre-seed companies? Well, please reach out to me afterwards. Send me an email. I'd be happy to talk with you. We do, as I mentioned, a lot of work with startups. So happy to talk to you about what we do and the kind of packages we have. So my information is on the screen. Feel free to send me an email or give me a call, but I'd be happy to answer that question offline. Okay, we're at 10:20. So just wanted to see if we have any final questions, anything that anyone wanted to touch on that I didn't get a chance to discuss. Let me run through the questions and see if there's any others here. Yeah, so again, the link to the recording will be shared. It'll have the slides on there. So if you missed any part of this, you'll be able to get it in probably within the next day or so. Okay, we got a few more messages. So, okay, so what, this is a great question. What should a startup look for in an early attorney? Yeah, that's a great question. So I would look for someone that obviously is experienced in the area that you need them to be experienced in. If you're a startup and you're looking to, form your company, raise capital, then it really should be a corporate attorney that has done a lot of work with startups. There are all different types of corporate attorneys, and some corporate attorneys focus on, public companies. So for example, corporate attorneys that take companies public or do a lot of the public securities work, or there's attorneys that focus more on mergers and acquisitions. So when a company is at a later stage where it's a target to get acquired, then they can come in and manage that M&A process. Other attorneys focus on working with startups and emerging growth businesses. That's the kind of corporate attorney that would be most familiar with and regularly deals with the kind of issues that startups deal with. So that would be first and foremost. But also what's critical is just making sure you have a good, good feel for that attorney. I oftentimes will be telling people I talk to that, look, it's important to get someone with experience in reputable firm, but it's probably the most important thing is make sure you feel comfortable with that person. So is there the right chemistry? Do you feel comfortable talking to them? Do they give you the sense that they really care about what they do? They enjoy working in this area? Do they enjoy working with you? Do you have a good relationship? The last thing you want is, even though they're super experienced, it's just not the right fit from a personality standpoint. You just don't really get along with them. You don't really enjoy working with them. It just makes that experience that much less enjoyable. So, if you have your ability to work with someone who's experienced and someone you really enjoy working with, that's probably the best fit. Okay. What's the difference between venture capital for an IP, like a motion picture project, and brick and mortar business? So, the way the VCs look at things, I think I mentioned earlier on in the presentation, is if they're focused on your industry, then they're going to know sort of the ins and outs of that industry. So there are definitely funds that invest in motion pictures and in movies and things like that. So they know the industry, they know the players, they know the kind of returns they can expect. They know the risks inherent in that type of industry. So they're going to be probably better suited and obviously more familiar and maybe even more valuable. We talk about smart money, but if it's a VC firm, and let's say you're in the motion industry, motion picture industry, you go to a VC firm that's invested in a whole bunch of projects in the motion film industry, they're probably going to have the contacts that are going to be super helpful to you. Whereas if you go to another reputable, good VC firm with a lot of experience, don't have those connections, might be a totally different experience and may not be giving you that value add that you would get from a VC focused on your industry. So the difference, I think, is, the VC is going to approach their investments a lot of times the same way. They're looking to mitigate risk, assess, identify, assess, and mitigate. So they're going to do this same kind of diligence. They're going to do, be looking at the team, the type of technology or product or service. Is it scalable? Those are all going to be sort of common across the VC, mindset, and when they're looking at it. But obviously, the deeper experience they have in the industry, the better they're going to be able to assess that risk, which I think is better in a sense for you, because you want to make sure you've got someone that can really assess the risk. So when they're committed, they're really committed. They know what the challenges might be for your business in your industry. Okay. Can you quickly talk about blockchain token sale to private investors? That's a great topic. It's not an area I really focus on. I know our firm does a lot of work in this area. I'd be happy to talk to you offline on that. Okay, well, I think we got about 5 minutes to go. So, happy to answer any final questions. But I'll leave you with one thought is, no matter what you're doing, or no matter what stage you're at, if you're the kind of company that's going to need outside capital, and if the VC route is going to be important or helpful for you to get to your ultimate goal as a startup, then, take the time now before you even go out to talk to investors and really focus in on some of the stuff that I talked about. Get to know, your business, get to know the models, get to know the documents, get organized so that you're in the best position you can possibly be in when you get to the point where you actually get to talk to a VC, and then even better when you get to the point where you have a term sheet. Okay, so another question, we got a couple more minutes. So should you ever have more than one attorney in early rounds? Well, yeah, I don't think you need more than one attorney, more than one corporate attorney, so to speak, if you're, needing help on the corporate side. You may have more than one attorney because you might need to bring in attorneys in different areas. So for example, you may need help on the corporate side for, an earlier round to help you with financing and all the things we talked about. But you may also need to be talking to an employment lawyer or an immigration lawyer or an IP lawyer, and they're all very specialized. So I would be a little leery of, having one attorney who says, "Oh yeah, I can do all your corporate stuff, I can do your immigration, I can do your employment, and I can do your IP," because it's an incredibly complicated area. It'd be like going to a doctor and saying, "Look, I need to have brain surgery. I've got cancer, and I broke my right arm." And the one doctor you're talking to says, "Oh yeah, I can handle all that for you." I wouldn't feel comfortable having that doctor handle all three of those issues. It's the same way in the legal space. It's highly specialized. So yes, you may be working with more than one attorney, but probably not needing to work with more than one corporate attorney or more than one firm, for corporate work. Now you may work with more than one corporate attorney in the same firm, but maybe not two different firms. Okay. Do attorneys work for the shares of the company? Some do. I know a lot of firms oftentimes will take a small piece. There are some ethical rules and some professional rules that prohibit taking on more than a very de minimis, very small amount. And it's oftentimes frowned upon because, the last thing attorneys want to do is have a conflict of interest. We want to be totally objective and focused on just protecting our clients' interests. And as soon as you start getting shares in a company, there's a question of whether that presents a conflict of interest. It can be done if it's done appropriately, but generally it's frowned upon. I think we've got time for maybe one or two more quick questions. Is there a general rule of thumb about how much investor or fund is looking for in a return, such as in a seed funding, like 25 or 30 times? Any comments? Great question. I think if you talk to different firms, they might have somewhat different answers, but ultimately it's going to be a very high multiple. It's going to be the home run, as I said. So, I would say, at least sort of a 10 times multiple, but oftentimes if they're hitting 20 or 30 or 40 times, that's kind of the home run that they're looking for. So if they made, a $10 million investment and they're able to return 30 million on their investment or 40 million on their investment, that's a good return. If they made a $10 million investment and only got back, 12 or 15, yeah, they made a return, but that's not the kind of return they're looking for. So, I would say they're definitely looking for a much higher multiple than just getting their investment back plus, 1 or 2 times. I don't have a very specific number, but, I've heard oftentimes, yeah, if they can get a 10 times multiple, even a 5 times multiple or 10 times or anything more than 10 times, that's at least starting to get into the ballpark. Okay. Oh yeah, there's a clarification to the question. Yeah, so for For IP attorneys, again, it's very specialized. So yes, if you've got IP you want protected, definitely talk to an experienced IP attorney, and preferably an IP attorney that understands your technology. That's going to be super helpful. All right, well, we are at just about 10:30. If anyone has any additional questions they didn't get a chance to ask, feel free to reach out to me. Happy to chat with you or correspond via email. But I wanted to just say thank you to everyone who attended. It was a great turnout today. We had a lot of people attending from a lot of different areas. And it was just great to be able to chat with you and give you some insight and some thoughts and ideas on how to prepare to do a venture capital financing. I wish you all the best. If you ever need anything, or if, again, as I said, if you had questions you didn't get a chance to ask, feel free to follow up with me. Be happy to chat with you. But hopefully this was some information that you can take away. And there are a lot of other resources out there, a lot of great articles or a lot of great videos. There's just a ton of information, and sort of spending some time to go through it and educate yourself on some of these thoughts and ideas we talked about, I think will serve you extremely well going forward, especially if you're going to be doing your first venture financing. So again, thank you so much. I wish everyone a great rest of your day or evening, and hope to talk to you again soon.